toca el... Ya, got it.
Ya estoy
Yeah.
empezando a grabar.
Uh, Hello everyone. Today we are going to talk about hi everyone. We are group one. Today we are going to talk about credit default swap. Next one, please. This financial instrument aims to provide cover against the risk of default of the issuer of a bond or debt, cataloged as the most known creative derivative that makes the transfer of credit risk among market participants with the aim of obtaining greater efficiency. In simple words, the CDS is basically a contract in which protection is granted to the buyer for a certain period of time. With this, credit risk was drastically reduced. So a CDS is the best and most common measure taken to reduce the risk of corporate default. It is a hedge against losses that could arise due to the seller default. Both the individual bonds, the coupon structure, and investor decisions or strategies maintain relatively low liquidity in the comparative bond market. Next one, please. Credit default swap is a financial agreement between two parties, which consists primarily of one of the parties, the buyer, acquiring protection from the other party, the seller, against losses or defaults that may occur during the agreed period of time. Therefore, with the security of the CDS, the first party makes the agreed payments until maturity with the certainty that his money is safe. Likewise, the seller agrees and undertakes to comply with the payment terms, and if these are violated, he undertakes to assume the consequences. This is due to the fact that in case of default, the seller would have to assume the entire amount agreed and the interest generated in the period. Basically, the function of the CDS is to keep buyer out of risk, since they take this measure to protect themselves from the credit risk that the seller may have or not comply with the agreement, such as corporate debts, sovereign, or government debt. It should be noted that the CDS were initially traded for a decentralized over-the-counter market. Therefore, unlike the exchange market, the background search may be more complex than the market. Therefore, unlike search may be more complex. Normally, the CDS are negotiated in the over-the-counter market, like I mentioned before, in which three parties are mostly involved. The first one is the issuer of the debt, which are institutions that act as borrowers. The second one is the buyer of the debt, which becomes the buyer of the CDS once the contract is signed. And the last one, the seller of the CDS, which are mostly large companies such as banks or insurers who are who will guarantee the deal between buyer and issuer. So it should be noted that most of these CDS contracts are supported by a continuous premium payment. So a buyer concerned about this loan defaults uses CDS to amortize and offset his risk. Next one, please.
One, the hugest credit default swaps. Its main buyer are hedge fund managers, central bank, regulator, rating agencies, insurance companies. Bank can use the debt, then the fraud corporate or sovereign risk without having to trade the actual assets. Is the International Swan and Derivative Association were in 1985 as the International Swap Dealer Association. It's a private professional organization that brings together the largest player in the financial derivatives market. Its main purpose is to amalgamate, agree, and standardize derivative contracts, and improves the regulatory policy applied to them with the aim in changing the liquidity of the market while increasing their reliability. And the risk, every investment is exposed to inherent risk. The return of it will differ from the expected return, giving the possibility of part or total of the original investment. The great risk is the possible loss of principal other type of financial reward assumed by economy agents due to breach the contract obligation by counterparties. The payment of interest by the issuer for the debit compensates investor and lender for the credit risk met. The higher the perceived credit risk for instrument, the higher the interest investment will demand in change for investing their capital. Next, please.
Uses. Next one, please. Hiding. The head risk investor by credit default swap to add a layer of insurance to protect a bond, such a mortgage backed security from defaulting on its payment. In return, a third party assumes a risk in exchange for a premium. Next one. Speculation. A speculator is someone who assumes a risk with the hope of gain. Buyers of credit default swap are in a similar position to short seller of stock in some ways. They sell what they don't own and hope to gain from the adverse develops affect underlying security.
In advantage, this swap protect the buyer against the risk of non-payment by an entity. The cost of such protection is very low. Due to the lower risk, the buyer can invest in riskier investment. This simply means more investment and could push the national economy upward. The seller have a portfolio with a vast diversity of such swaps, which cover the risk of one more swap going default. So at the end of the day, they am making a good profit. This how Silicon Valley become American innovation hub. And in disadvantage, the swap went irregularity for the longest time till 2010. There was no one to ensure whether the seller of CDS have enough reserve money to pay the buyer in the case of the default. CDS seller for mitigate risk for hedging with other CDS DR. Next, please. Thank you.
Okay, CDS history. Now I'm going to talk about the origin of the CDS. Well, the credit default swaps, CDS, were first introduced in the mid 1980s as a way to transfer the credit risk associated with commercial loans while also freeing up regulatory capital in commercial banks. Um, Commercial bank moved the risk of default to a third party by entering into CDS, and this risk was not counted against their statutory capital requirement.
Okay, in this part, the criticism to CDS usage. Next, please. One of the main criticisms of the CDS by experts is the poor and reduced liquidity and its high leverage. This will be used in ideal instruments to influence the debt market, and it is that in practice it is observed how to the prices of the bonds follow the evolution of the price of CDS, and it's very easy to influence the price due to having scarcity liquidity. We can also see how in the markets the difference observed between the yield of the Herman bond and the bond of another country in the Eurozone are amplified by the CDS market. What is this about? The process is as follows. The volatility in the debt markets encourage operators to cover themselves with CDAs, uh, which raises the perceived risk in this market and feeds back the process of deterioration of the debt and that is being covered. Next, please. Uh, how to promote to use of this instrument? Uh, to achieve this development, an intervention is necessary with measures that reduce the volatility in the debt markets, encouraging operators to cover themselves with CDAs. The operation of any given day we can be is indicated below. Hedge funds take short positions in debt immediately afterwards, they act on the prices of the CDAs. These are transferred to the price of the debt. They increase the profitability of the debt, and therefore the prices fall of the debt. An opportunity they take advantage of to buy the debt that they have previously sold and thus close their position with significant capital gains. Next, thank you.
Okay, in Peruvian case, but in the part of Peru, as a result of the global financial crisis, the CDS market shrank 47% between June 2008 and 2010. It still represents 5% of the total the over the counter derivatives market, with about 13 billions of dollars in national value. Here we can see the evolution of the basic points, the spread of the CS in Peru. We can compare with other countries of Latam, in Brazil, Chile, Colombia, Mexico, where it's actually very similar. Because in the recent times there has been highly volatility in the exchange rate at the international level. This is explained by different trade tensions and economic measures adopted by China and the United States mainly.
I'll be speaking about terms of typical CDC contract. To put it simply, a credit default swaps, or CDC as it's called, is a insurance against a bond falling. If nothing bad happens, your premium payments are null and void. Buyers and sellers all protection enter into what amount to a legal contract. If credit event occurs in reference instrument, the protection purchasers will get compensation under the terms of the contract. In exchange, the protection buyer will pay the protection seller on a regular basis. Federal law forbids any fraudulent, manipulative, or otherwise illegal activity with credit default swaps. Insurance against the possibility of corruption defaulting on its steps is provided through the credit default swaps. Buyers and sellers of protection enter into what amounts to legal contract. Next slide, please. Conception. A credit default swap right allows multiple parties to trade the credit risk inherent in a fixed income instrument. The credit rating of a fixed income securities produced may be transferred from one entity to another via the use of credit default swaps, a form of financial derivative instruments in return from premium bearer loans, or a kind of insurance that protect lenders against the possibility of loan default by a borrower. In the certification of deposits, CDC's markets, a protection buyer may cancel and pay off from a contract upon the occurrence of a credit event. Credit default swap CDCs are kind of financial swap agreements in which the sellers commits to reimburse the buyers in the case of a sovereign default by the borrowers, or other credit events. In other words, the buyer of the default risk is protection the buyers against the defaults on part of the benchmark assets. An investor may make a bet on whether or not the credit default swap offered by a corporate is priced appropriate by buying the swaps. Investors may hedge their bets by buying the credit default swaps insurance if they fear a fall in company's creditness. Next slide, please. Conclusion and recommendations. Next slide, please. Conclusions. A financial tool such as CDC can produce a social benefits such as establishing an instrument for those who can manage credit risk, disclosing information about the credit risk, creating a more flexible and efficient financial system than 25 years ago. I would also produce certain social costs such as creating a bubbles that ending financial crisis, loss of confidence in the financial market, lack of transparency in the market that makes possible the manipulation and speculative use and the lack of transparency in the markets that makes possible with CDC not only buyers benefit but also companies or sellers since since thought that they provide the security that other people need and obtain financing thanks to them. Therefore, from the seller's point of view, this means not only an opportunity to obtain more income, but also used as an indication that shows the movement of the market and how the company is currently.
The recommendations. In order to ensure full transparency of the capacity of the selling entity to back the credit insured they offer, the validity of the CDS transactions should be provided without a regulation, control and complete oversight by a regulator and supervisor institutions such as US SEC. Create and centralized institutional, private or public system as a clearinghouse where all CDS are treated in a transparent manner with the obligation of appropriate deposit of funds or collateral for insured claims. Thank you.